Welcome back, everyone. I hope you're having a great day as always. And in this episode, we're going to take a look at 4 of the top dividend growth companies you can buy on the market right now. These are not the high yielding names that have a current dividend yield of 4, 5, or 6%. These companies come with a lower starting yield from 0 to 3%, but they grow that annual payment at a much faster rate than some of the current high yielding names you can find. And also with these companies, there's usually a lot more share price appreciation over the long term compared to some slow growth, high yielders you can find in the utility or telecom sector. So in this episode, we're going to discuss 4 different companies who operate in very different sectors and have diverse North American and global operations and generate growing revenue every single year. And these companies are some of the strongest blue chip names on the market that also provide investors with very fast annual dividend growth, which is great to see. And for each of the 4 names, we're going to take a look at their current operations, their recent financial performance, the share price performance, and of course, all the dividend information, including the growth and the safety. But before we jump into that first company, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and we're going to jump straight in to the first company in this episode, one of the strongest retail names on the market, and also a very fast dividend growth name, and that is ticker HD, which is the Home Depot. They currently trade for $315 per share, and over the trailing 12 months, they are up by 32%. And we all know the Home Depot, they're spread out in all 50 states in the country, as well as Canada and Mexico, and one of the largest and strongest brands in the retail space. They currently have a market cap of over $338 billion, a nice dividend yield right around 2.1%, and their current forward PE sits at 23.3. And over the long term, this has been one of the best performing stocks on the market, growing by 135% over the past 5 years, and for the past decade, they are up more than 741% in just terms of share price appreciation. And the company just shared their Q1 2021 earnings, and their total revenue exploded, growing over 32% from the 2020 number. And this company has benefited extremely well due to the pandemic and the increase in demand for home renovations. And if we take a look at the recent numbers, over the first quarter, their EPS came in at $3.86, crushing the expectation that was set at $3.08. And total top-line revenue in a 3-month span was at over $37.5 billion versus the $34.96 that was set by analysts. And what's important to know is their income was up dramatically over this quarter as well. In the first quarter, net income came in at $4.15 billion, up from the $2.25 billion back in 2020. So a major growth rate of over $2 billion in extra income year over year. And during this release, the company also came out with a $20 billion share buyback program, so they're going to return a ton of capital to their existing investors over the next few years. And of course, because we're talking about dividend growth companies, if we take a look at their dividend information, they have a current yield of 2.1%. Their payout ratio is extremely sustainable, making up only 49% of their total net income, so a lot of room to continue to grow the business with the reinvested capital, plus excess capital to continue to grow that dividend for many years going forward. And the current 5-year dividend CAGR is at over 20%. So although your starting yield is on the lower end, right around 2% right now, that annual payment is compounding at an average of over 20% per year, which is absolutely amazing. And if we take a look at their financials, although Home Depot is a big name company, they're not slowing down whatsoever. And their total revenue continues to grow every single year. Like clockwork, the total top line is growing annually every single year, with a major expansion over the past year to $132 billion through the trailing 12 months. And as we're evaluating a dividend company, we have to take a look at their cash flow statement, because every single quarter, that dividend payment is paid out in the form of cash. And we can see that Home Depot's total free cash flow has exponentially grown over the past 5 years, from $10.1 billion back in 2016. Every single year, their total free cash flow continues to grow to up over $17 billion in the past 12 months as well. So the company's growing revenue, they're expanding their operations, they're generating more and more cash every single year, and they're rewarding their shareholders with big share buybacks as well as a fast-growing dividend. And at this current point in time, this 2% yield is considered very safe, coming in with an 87. So that means it's extremely unlikely that over the shorter term, we should expect a dividend cut to come from Home Depot. So this may be one of the top dividend growth names that you may want to add to a watch list for your own portfolio. Do some research into the company. They've been growing for the long term, and going forward, although we are trending towards an e-commerce based society, I think Home Depot and home improvement warehouses are the type of stores that are always going to be in-person shopping experiences. I think it's going to be very hard to purchase all the goods for your home online, and I think going to Home Depot, seeing the tools, seeing the materials, seeing the products with your own eyes, being able to touch them and speak to a worker is always going to have benefits. So a company I think is going to be around for the long term. I don't see any other competitor knocking Home Depot out of the market leadership position in their specific industry, and definitely a brand I own in my personal portfolio that I plan to hold and reinvest those growing dividends every single year. So this was the first company we're going to discuss in this episode, and now if we jump over into company number 2, it's ticker TXN, which is Texas Instruments. They currently trade for $185 per share, and over the trailing 12 months, they are up by 61%. And this is a company that operates in the semiconductor space, which is in great demand right now, and we're seeing a ton of chip shortages impacting every industry in the market. And over the next 3 to 4 years, the entire demand for the semiconductor sector is only going to explode. And if we take a look, they have a market cap at $167 billion, trading with a forward PE right around 24 and a nice dividend yield of 2.25%. And over the long term, this has been another company with excellent long-term share price appreciation of 217%, and over the longer term, over 419% for the past decade. And if we take a look at their Q1 report, they started off 2021 with some amazing numbers. In the first quarter, total revenue grew 29% year over year, operating profit was up 56%, their bottom line or their net income grew 49% year over year, and their earnings per share was up 51% as well. So overall, the company did a great job over the first quarter of 2021 with some major expansion. And over the past year, the company returned $4.5 billion to their shareholders in the form of dividends and share buybacks. And currently, their dividend payment only represents 56% of their total free cash flow. Meaning, similar to Home Depot, the company's got a lot of excess cash to reinvest back in the business, to pay down debt, and to grow their operations to generate more revenue in the future. And having a sustainable payout ratio from free cash flow of only 56% also means that the total dividend can continue to grow over the longer term. And if we take a look at the dividend stats, the current yield sits at 2.25%. They pay out $4.08 per share per year, and their current payout ratio in terms of net income, not free cash flow, sits at 54%. And over the past 5 years, their annual compounded dividend growth rate sits at 21.75%, which is absolutely phenomenal. And they're another company who pays out a very safe dividend, coming in with a 90. So very unlikely, very similar to Home Depot, that this company cuts their dividend anytime soon. And this dividend safety score combines a bunch of different financial ratios from the balance sheet, the cash flow statement, and even the income statement to generate a 1-digit score to help provide you with a little bit of an overview on the safety of a company's dividend payment. So we can see right away that the first 2 names on this list offer yields right around 2% to start out, but over the long term, your capital is growing dramatically and your annual dividend is compounding rapidly as well. And now if we transition into the third company in this video, it's going to be ticker AVGO, which is Broadcom, another semiconductor player that I own in my personal portfolio as well. They trade for $455 per share, and over the trailing 12 months are up by 63%. and another name that over the long term has provided some great returns of 210% overall during the past 5 years. They have a market cap at $185 billion, a current yield of 3.16%, so a nice higher one compared to the first two we took a look at, and a very low forward PE of only 16.9, so actually a lot of value coming in at Broadcom at this current level. And if we take a look at their investor presentation, net revenue has continued to grow exponentially year over year to close to $24 billion in the 2020 fiscal year. Their gross margin has improved as well to a massive 73.5%, so this is a very profitable company, and their adjusted EBITDA has reached all-time highs as well. And like we discussed, free cash flow is very important for dividend growth names, and we can see Broadcom continues to expand that number every single year. And from only around $2.7 billion of total free cash flow back in 2016, they have more than 4 times that in a matter of 5 years to over $11.5 billion of free cash flow in 2020. So as you know, if you follow the channel and you follow my personal portfolio, I am a lover of free cash flow. As simply as possible, I believe you can evaluate a company by determining how well they can generate cash in the future. And we can see all of the names in my video and in my portfolio are companies who generate growing free cash flow every single year. I own blue chip companies with consistent operations and ability to grow the cash they get into the company over the long term. And if we jump back over to Broadcom, along with their growing revenue and income and cash flow every single year, the company has done an amazing job of rewarding their shareholders with massive dividend growth. And we can see that back in 2016, their annual dividend payment was $1.94. And over the past 5 to 6 years, they have a dividend CAGR of 49%. 49% dividend CAGR is absolutely ridiculous. And their full annual payment back in 2016 was $1.94. And now every single quarter, they're paying out $3.60. Not annually, per quarter. And that $1.94 per year has now grown to over $14, which is absolutely spectacular. And if we take a look, they have a nice starting yield right around 3.26%. So currently, the yield is a little bit higher to start out with, and the dividend is compounding at a massive rate. And currently, their payout ratio makes up around 53% of their total net income, and like we saw, a huge dividend CAGR for the past 5 years. And the company also has a safe dividend coming in with the 65, and this is another brand I own in my portfolio as well. It makes up 1.4%, so it is a smaller position. And in total, I own 3 shares that has a current market value of $1,300. So Broadcom was the third company we're going to discuss in this video, another fast-growing semiconductor player with massive dividend growth over the past few years. And now we're going to take a look at the fourth and final name in this episode, and it is ticker MA, which is Mastercard. They currently trade for $367 per share. Over the trailing 12 months, they are up by 24%, and the company now has a market cap at $357 billion, and they trade with the forward PE that is on the high side, right around 46. And of course, Mastercard is not the company that comes to mind when you're thinking about dividend cash flow. And the current yield currently sits at a very tiny 0.49%. Of course, when you buy into Mastercard, you're going for that long-term share price growth that we can see comes in at 281% in just the past 5 years, which is absolutely phenomenal. And their brand over the long term, I believe, will continue to grow, and Mastercard along with Visa are going to dominate the financial debit and credit card market for decades to come. And if we take a look, currently they've done a terrific job of expanding their total revenue every single year with a slight pullback as of late due to the pandemic. These credit card companies make a lot of money in the business world and the travel sector, but because of this pandemic and people working from home, that did see a major reduction. So their total revenue did come down as of late, but I am treating it as a short-term volatility metric, and I do believe going forward into 2022 and beyond, the total top line will reach new record highs. And when you buy into Mastercard, you're getting an extremely profitable company. over $15 billion in total revenue during the trailing 12 months, with over $6.5 billion of profit over that same year. So we have net profit margins above 40%, which is absolutely phenomenal. And taking a look at the dividend, although the yield comes in very small at around 0.5% right now, which is pretty much minimal compared to the share price appreciation, but also the payout ratio is very tiny, only making up 22% of their net income. So a lot of room to reinvest back in the business, and that's how they're operating and growing so rapidly. Plus, they're growing that payment, averaging over 19% per year, which is absolutely fantastic. And they have a very safe dividend as well, with the highest safety score possible, coming in at a 99. So another company where it's very unlikely that we see a dividend cut coming anytime soon. And I think with Mastercard, a company that's extremely profitable, great net margins, only a 22% payout ratio, and a dividend yield that's very low, I think over the long term, their dividend will be very safe. And I currently own 8 shares of MA. My total market value is just below $3,000, and I'm up close to 18% on this position. So another holding I actually invested with my personal capital in this $100,000 dividend growth portfolio. So as a whole, if you follow the channel, if you're subscribed and part of the community, you know I'm a dividend growth investor building up this portfolio to one day achieve financial freedom. And as a dividend investor, I like the companies who prioritize long-term capital and share price growth through reinvested dividends and capital returned to shareholders every single quarter. So my portfolio is made up of dividend growth companies, and in this episode, we took a look at 4 names on the market. I own 3 of the 4 names in my personal portfolio, and the one company I do not own is Texas Instruments, but it is actually one of the top names on my watch list, and I do plan to buy into the company during any upcoming dips or volatility we see in the markets. So I'm going to wrap up the video now. Thank you for watching to the end. I'm going to thank you as always for supporting the channel, and if you haven't done so already, please hit that like button and subscribe. I'm the Gen Z investor, and we talk about the stock market every single day, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and I will see you in tomorrow's episode.